Welcome to the daily update, where I'll go over the action in the market for Wednesday, September 18th, and then we'll see how things look for Thursday, September 19th. The much anticipated rate cut finally happened. The Fed came in, they cut at 50 basis points or 0.5%, and there was the initial gyration over what happened. And then as Chairperson Powell was speaking, and I'll go through that again here in just a moment, and the market gyrated itself lower. It's one of those crazy days where the market just acts in a strange way. I checked the futures right before I started recording. We're up about 1% with the S&P right now, but this is 8 hours before the market even opens. So anything can happen. But on the heels of that, we'll have to see, is this going to be able to take the market higher? We are dealing with a confirmed Hindenburg omen, which in the past has sometimes been quite negative. And we're also into a weak seasonal time, especially after this week. Now, we're finishing out options expiration on Thursday and Friday, and it's the week after that can be quite negative. But that doesn't mean that things will be positive this week. Although we're still looking positive in the short, intermediate, and long term, we're seeing some weakness, and there are some things to cause us a bit of concern, and I'll go through that as we go through the video here. I do have the SPXInvesting Program. It's up, it's running, it's currently free right now. You can email me if you have any questions. There's a link to a video that will tell you more about the program, and you get early access to the daily and weekly videos that I do. And the daily video is the real central point of all of the analysis that I do. All of the other videos around the outside, they're weekly versions of videos, and they're meant to tie into the daily video. All right, let's go back and talk about what happened and then look at some charts. We had pretty much a flat open, not a real surprise. The futures were pretty sleepy, slightly positive there, but everybody was really anticipating, okay, what's the Fed going to do? And then what are they going to say? After the open, we just kind of drifted above the unchanged level and drifted below it. Really not a lot of conviction there. Then after the Fed made their announcement, we gyrated higher above R1 at 56.66, and then we gyrated ourselves back lower and dropped below the unchanged level and ended up closing negative. We were down 0.29% on, get this, below average volume. That's interesting. And we are positive in the short, intermediate, and long term, but there are some concerns. Of course, interest rates were the big story in Wednesday's session as the Fed did cut rates. And we want to keep an eye on all the different geopolitical things, not really having an impact on the market right now, but that can always change. So the Fed did cut rates by 50 basis points. That's also 0.5%. And I'll go through that again. I have another slide just for this. The Dow and the S&P did set new intraday all-time highs, not closing highs, but they did hit new intraday highs that way. And the ADX is still cross positive, but it's not trending. We're hoping that some kind of a trend is developing. It's just not quite there yet. And the Hindenburg omen signal was confirmed back on September 12th. And we just have our stochastics now that are looking extreme in the short term. In the intermediate term, the CMB composite, it is coming down, but just barely extreme. Excuse me. And the Erin indicator did not move, and it's still extreme positive. The bullish percent index did go up, and that's encouraging that it went up, but it's also getting to kind of an extreme reading itself. And we're still extreme with our 150 and 200-day simple moving averages in the long term. And so we've changed the scenario a bit here. The Fed has cut rates by, it should be 0.5% there, because this soft landing idea that seems to be elusive, that really hasn't happened all that much before, it seems to be what they're anticipating happening. And that's what the Fed is now expecting. That's what the market is now expecting. So it seems like it's possible. Okay, the dollar was up and interest rates were up. This could have pressured stocks. We closed at 3.69% with the 10-year yield, where we had been at 3.65%. We're still inverted with the we're still inverted with the 10 to the 3-month yield curve, but the 10 to the 2 is uninverted. I'll show you that chart. Sentiment is still positive. We ticked up and came in at 56, where we had been at 54. We're still not trending, but we are positive with the green line on top, but we're still below the moving average and still below 20. With the down day, our bias is now negative, but the momentum is still positive. So here's just an extra little recap of the Fed meeting. They did cut rates by 50 basis points. We're down in the 4.75 to 5% range. And it was not a unanimous vote to cut these rates. Fed Governor Bowman preferred a 25 basis point rate cut. And then the directive or the statement that they came out with, they said that the committee has gained greater confidence that inflation is moving substantially toward 2% and judges that the risk to achieving its employment and inflation goals are roughly in balance. Okay, then they come out with another report that used to not really be paid attention to, but now they look for anything and everything to feed off of. The summary of economic projections, it had a shift saying that the median estimate for unemployment in 2024 would be at 4.4%, where the last time they came out with this report, it was at 4%. And they also shifted down the PCE inflation to 2.3%, where it had been at 2.6%. And then the core PCE is now at 2.6%, where it had been at 2.8%. So you notice the inflation's coming down. Unemployment is going up a little bit there. And then they have this thing called the dot plot. It shows a median estimate in 2024, 4.4%, that implies another 0.5% cut this year and another 100 basis point cut, so 4% in 2025. So this is kind of what the market was hoping for. It's what seems to be giving some fuel that, okay, the economy's not falling apart. The Fed's able to come in and cut rates more to fine tune the economy and to help economic growth rather than reacting to some catastrophic event. But that can always change. This is just what we're going with for right now. And then during Chair Powell's conference, he defended the 50 basis point cut, saying a proper recalibration to make sure that the labor market and the economy remain solid and that the intent of the move is to make sure that they remain there. And he also said that the Fed doesn't feel like it is behind the curve. They always say that. It's their job to be ahead of the curve, but they really are. And that the larger cut today can be construed as a sign of the Fed's commitment not to get behind. Well, there's already a lot of people saying that they've kept rates higher for longer, and that's done some damage. But you can say whatever you want. We just need to look at, okay, what's the data telling us and showing that things are hanging in there as far as the economy. All right, then we did get some economic reports. We had the weekly MBA mortgage applications. They were up 14.2%. Refinance applications. Now that interest rates are starting to drop, people are really jumping into refinance. They were up 24%, and purchase applications were up 5%. Housing starts, which is considered to be a leading indicator, it came in at up 9.6% on a month-over-month basis, and you would annualize this to 1.356 million units. That's more than the 1.32 million they had expected. Building permits were up 4.9% month over month. Annualized, that's 1.475 million. And that's also more than the 1.41 million they had anticipated there. So here's a, excuse me, and incidentally, I probably sound different because I'm using earbuds to record rather than my typical microphone. You can see a real move up here in the mortgage applications. And then we're starting to turn back up a little bit after we had been declining with both the housing starts and the building permits with a 3-month average. And this is the seasonally adjusted annual rate here, which it does show in advance. So that's good for the housing market, and it's usually really good for the economy when they're building and buying and selling houses. All right, so we have the Small Business Confidence Index, which came out earlier in the week. We're still down below this recessionary area, and we came back down to 91.2, but then we also look at this is a 24 period moving average where it's just starting to turn back up, but it's still relatively negative. And then it says, yes, the Fed has cut with stocks at all-time highs and the bulls liked it. This is just showing times when we were at all-time highs at that point and then what happened after that. And it's very blurry, but you can see what things look like 1 month, 3 months, 6 months, and 12 months going out, and what the returns were during that time. So it tends to be positive for the market if you can see that chart. This is a different way. I don't use the cup and handle. I'm not a real patterns type person, but when we're going up and we're looking more positive, they tend to post more positive looking charts with some possible target frames here for this. And if we do start to fall, some different support levels. And then there's actually a little bit less cash right now. It went down to 4.2% from 4.3. That probably means that that money's going into the market, but it's still coming off of a pretty low reading here. And then what's the median index return after the first rate cut? Well, when you look out 3 months, we tend to be positive. But what really benefits are the mid caps because they're trying to gain their status from being a small cap into a large cap. And so they tend to do well. The S&P does pretty well after that. And what's been really the focus lately is people have been talking about the Russell, the small caps, because they tend to benefit as well from rate cuts because they usually have a lot of debt, but they do benefit, but not quite as much as the S&P and the mid caps. And then what are the projections going forward here? The rate cut profiles, where the purple area, this is the Fed. This is from that report that they released, what they're looking at doing off into the future. This is Deutsche Bank, the red diamonds here. And then the Fed fund futures are actually coming back up a little bit to match more where the Fed is at currently. And what are we looking at on a valuation basis? As always, the US has the highest valuation of the S&P 500. It's over that 20 level. That's considered to be expensive at that point, coming in at 21.4. And then it can be compared to other valuations around the world. And then global growth expectations still remain weak. We are bouncing back up a little bit, but we want to get this back up, showing that not only are things okay in the US, but that would help if we're seeing global growth as well. And then we did get retail sales coming out, and we're hanging in there pretty good. We're starting to go back up with the latest reading. It's sometimes a concern when we really flatten out with retail sales, because that's quite often what will happen right before a recession. Not really seeing that right now, but there are other things that you suggest that, yeah, recession is likely at some point. We just aren't really sure when, but it doesn't seem to be developing right now. But there's other charts that we look at that say, yeah, we could really go into a recession. And then this is the 12-month forward implied change in the Fed funds rate. They're just saying that a recession starting in the next year, according to what's happening with the rates, that there's a 98% chance that we're going to see a recession somewhere down the road within the next year. All right, didn't spend any time on Twitter. Here's our intraday chart. Really quiet open. We were right around the unchanged level. We dipped a little bit down, but then came right back up and went above the unchanged level. Then here's all the gyration that occurred, where we chopped our way above R1 and then came back down, went negative, chopped our way below the unchanged level to close negative on the day. And then you can see over here on the right-hand side, we are seeing a real uptick in the pre-market session, or the initial overnight session in the futures for the S&P. We're still kind of concerned about this. We have the red line above the blue line. We want to see the blue line above the red line, showing that growth is outperforming value on an intraday basis. And we're pretty much flat right now with S&P growth to value intraday. We would like to see this going up. If it really starts to turn and go down, that'll be a concern. If it does go up, that will be more positive, because we topped out back in August, and then the general trend was lower. We bottomed right here in September 9th or 10th or so, and have been seeing a nice run up since then. Well, the market's a little bit indecisive, so we'll be watching growth versus value in Thursday's session. So growth was down a little bit more than value, but they were both down for the large caps, down with the mid caps, and up more for the small caps than value. So we're still declining here with small cap growth to value, declining with mid cap growth to value, and S&P growth to value. We want to see it going the other way if we're going to stay more positive on the market. And we're also back down still at this 250-day moving average when we compare the growth ETF with the value ETF. We want to see this going up, and it's not doing that right now. We did see a little bit of a tick up here with discretionary to staples, but we want to see more follow through with this. We're still above the moving averages here with our large cap growth ETF. And our trend, we're trying to turn up. We're just right about on the moving average here. And we would default to positive because the green line's on top. But to be a confirmed trend, the ADX has to cross back above 20. And we've got a ways to go for that to happen. Trying to turn up and barely getting above its moving average here with the short-term ADX, but we're also positive but below 20. And we are still below average with volume. Kind of strange there. And we did get the latest reading from Investors Intelligence coming in at 2.15. That's neutral. And we're still kind of high here with the Ulcer Index, showing that fear is there. And we ticked up on a closing basis with the VIX on the line chart as well as the bar chart. When the VIX goes up, the VIX of the VIX, the volatility of the VIX also goes up. It went up pretty high here with the bar chart, but it actually closed a little bit lower on the line chart. But the momentum of the VIX is still down, even though the MACD is turning up slightly. Seasonality, this is what we're keeping an eye on here. This is one of the reasons that we're a little bit concerned about this point going forward for the next month or so with stock prices, because the VIX has a real tendency to rise during this time. That means stocks are going down. We're still getting into this red area with the SKU index, anticipating some kind of a big move. We went up with the equity put call ratio on the daily chart, but we're still going down and just barely getting into this extreme area. Now, if you look at this and where I have the red lines here, when we got to an extreme reading, which it still could go lower than this, but a lot of times this marked at least a slowdown, if not an actual short-term top in the market. So we want to be aware of that. And we're still declining here with our 10-day chart. We went up with this fair gauge where we declined with the other fair gauge. So we're seeing a little bit of mixture there. And we were down slightly with our risk on versus risk off ratio. To be risk on, this would go up. And that means folks are favoring the high beta stocks, the Apple, the Google, the Amazon, Netflix, Nvidia, those stocks. And we're still right in this band here when we look at volatility risk premium. And we were flat to slightly declining with the advanced decline line based on price. We did decline a little bit based on volume, but taken together, these are still pretty healthy. They're above an advancing moving average. And we did see some more new highs than new lows. It is dropping off a little bit here. So we're pretty much flat with our 5-day, but we're still dropping with the 10-day. And we're coming down a little bit. This is a little bit of a concern here. We're dropping with accumulation distribution, but we're still above an advancing moving average. And the boom indicator is rolling over a little bit. This is one area that we're going to be watching. We declined, but we're still positive with the advanced decline ratio. So we're above 0 based on price and volume with the advanced decline ratio here. This is another concern that I started seeing after last Friday. We're positive with the Chaikin money flow, another smart money indicator, but we are declining and the red line's going down. That's a concern to us. And we're declining with the Chaikin oscillator, another concern, even though it's still above 0, so it's positive. And we're going up with the green line and down with the red line with the vortex, another primary indicator. And we came down a little bit here, but the S&P with the NYSE advanced decline line are kind of going more or less in hand right now. We're still going up with the 50-period moving average of the new highs and new lows for the S&P. And the S&P based on price, the cumulative measure, we came down just a little bit, but we did break out above this previous high. We also came down based on volume, and we're also breaking out based on volume. And we ticked down a little bit with the NYSE cumulative advanced decline line, and we're pretty much flat with the NYSE advanced decline line, and pretty flat to slightly declining with the other NYSE advanced decline line. Then the common stock down just a little bit here, but breaking out, also down with volume, but also breaking out. We look at the new highs here for the S&P. We have a positive score for the day, and we're back to going higher with our 50-period moving average. That's internal strength, not only in the short term because of the daily chart, but more intermediate term because of the 50-period moving average. And looking at the broad market with the 5-period moving average of the highs minus the lows, we are still positive. And we are still getting a really high reading with the ZWAG NYSE breadth thrust, but it's not a trigger. We didn't get all the way down below this 0.4 level. When we look at the ratio between large caps and small caps, we did decline a little bit as small caps had a better day. And we came coming down, but still looking positive with our advanced decline line. NYSE common stock, the S&P, the mid caps, and the small caps. They're still above the advancing moving averages. So here is our daily chart. Not really much to show there. We're above the 50-day moving average, and we're just barely below the moving average when we look at volume. We turn back down with our 20, 50, and 200 period moving averages of the S&P. We're no longer extreme with the Stochh RSI, the Williams percent R. We never became extreme with the CCI 14 or the CCI 20, but these are still looking rather positive. We're not extreme with the short-term stochastic here, but we're rolling over and still extreme in the intermediate term as well as the longer-term stochastic. We declined, but we're positive with the force index. We're still looking good here with the condition of our 20-period moving average. We're above both lines, and they're both going up. And when we look at the simple and exponential moving averages, still above both lines. And we're into the +1 channel with our standard deviations chart. So that's not showing a real extreme movement now. We declined, but we're positive with those stocks in the S&P above their 20-period moving averages. Also declined, but positive above their 50-day moving average. We actually were flat to slightly up with those stocks above their 100-day moving average. And we were flat to slightly declining with those stocks above their 200-day moving average. So we're hanging in there for right now. We went up a little bit, and we're positive with the balance of power. We're coming down, but still just barely extreme with the CMB composite. The condition of the 50-period moving average, we're still above both lines, and we're still above both the simple and exponential moving averages. It'll be more positive if this blue line, which is the exponential moving average, would get above the red line. That means because the exponential moving average moves faster, and that would just mean there's more strength behind that move. And we're above all the plotted moving averages here in our moving average tree. We're positive with the go, no-go with the blue bars. We're coming off of the highest high value here and above the midpoint. That's still positive. And we're just not going up, though, with the TTM squeeze. It's pretty much flat right now. Standard deviation still showing that we're moving rather quickly right now over the last 10 periods. And we're just barely negative with the ease of movement. We're improving a great deal, but we haven't turned positive yet. And the Erin indicator is extreme positive, measuring the green line from the red line here, buyers versus sellers, and it's looking pretty extreme there. We declined, but we're still positive with the S&P McClellan oscillator, so we're still going up with the summation index based on price and volume. Not really seeing much of a rollover, at least yet. That's what we'll be watching for with this chart. We declined, but we're positive with the NYSE McClellan oscillator. So we're going up based on price and volume with the summation index for the NYSE. Still going up with the Swenlin trading oscillator based on price. We actually declined with the Swenlin trading oscillator based on volume. Still positive, but a little bit of a concern to us. We're positive with the parabolic SAR. We've gone over to neutral with the Elder's Impulse system for the S&P. We're positive on a momentum basis here with the PMO. We're a little bit above the moving average based on price. We're more above the moving average based on volume. We declined with the PMOs that are rising, but still we've been going up. We're going up with the buy signals and going up with the PMOs above zero. We're crossing over positive here with the moving average. We're starting to turn positive with the slope oscillator. The MACD's already crossed its moving average and is turning more positive. So we're turning back up with the short-term oscillators, intermediate-term oscillators. We're starting to turn up here with the tricks. And now the KST is barely starting to turn back up with our longer-term oscillators. We're negative but improving with the Copic curve. We've actually declined a little bit. We're no longer extreme with the Sean trend meter. This is the bullish percent index. It continues to go up, which is positive, but we're getting to a pretty high reading now. We want to keep an eye on this one as well. We're still going up with the NYSE bullish percent index, and we were up slightly with the NASDAQ 100 bullish percent index. We're above 50 and advancing with the money flow. We declined after being extreme positive with the ultimate oscillator. We ticked down a little bit, but we're still above the advancing moving average with on-balance volume. Rolling over a bit with our RSI 14 and 9, but still both are above 50. And we're coming back down into this other rainbow. This is based on the short-term 20-period moving average. This could be providing some kind of support here. We'll have to see if we fall down into this mini rainbow or we're able to bounce up off of that. Long-term weekly chart, still above this R2 pivot level. That's longer-term positive. And we're still looking good on a trend basis with the Heiken Ashi, the Kegi, the Renko is positive, and the three-line break continue to be positive. And long-term, we're looking good, but we're above this red line with the 150 and above the red line here with the 200 as well. We're positive across the board according to the Keller market model with all the indexes. We've switched back to negative in the short term with commodities, and we're negative across all time frames. The dollar is also negative across all time frames, where stocks and bonds are positive. And we had energy was up, and all of the other sectors ended up having kind of a rough day with technology leading things lower, followed by utilities. And we had some blue and some red here, or green, whatever you want to call it. A lot of this that happened, like this energy sector MACD crossover, that was right after the open. A lot of these other things that ended up happening were after the Fed made their announcement, and a lot of them tend to be positive. And the dollar going down, that can also end up being positive for stocks. But we're seeing some improvement here in the financials, healthcare, industrials. We set a 4-year high with the S&P. The Dow set a 4-year high, all-time highs. I mean, those are not negative things that are happening. We'll just have to see if there's more carry through with that. We compare the S&P to the equal weight version. We were down slightly as the equal weight held up a little bit better than the weighted version. Also going down just a little bit here with our other ratio that we follow. We came down after setting a new intraday all-time high with the Dow. It was down 0.25%. And we've gone from positive to neutral with the Elder's Impulse system for the diamonds. We're still above the 50-day moving average with the NASDAQ and the NASDAQ 100. So those levels are still holding. And we've gone from positive to neutral with the QQQs when looking at the Elder's Impulse system. The momentum for the NASDAQ 100 is still positive, and we're still above all the plotted moving averages here with the QQQs. Small caps were up barely 0.09%, but they're still looking okay. They have yet to break out above these previous prices, though. And when we look at the other small cap index, the Russell, we're still above 50 with the RSI. We closed and opened right about at the same spot here. We're above the 50-day moving average, and the momentum is positive. And we're still positive with the Elder's Impulse system for the small caps. The mid caps are also virtually unchanged, but slightly positive above their 50-day moving average and still above this pivot level. Still positive with the Elder's Impulse system for the mid caps. The Wilshire, a broad market measure, did decline almost 0.25%, but still above its 50-day moving average. And we're also down 0.27% with the total U.S. stock ETF, but still looking pretty good for now. And not much of a change here with the staples to tech ratio. We want this to go down if we're more positive on tech. If this keeps going up, that means the market is becoming more defensive compared to tech. Look at the financial sector, down 0.33%, but still looking pretty solid. The FANG index declined, but still above its 50-day moving average, even though the moving average is declining. And we're still in between this longer-term trend line and this shorter-term trend line. We've not been able to recapture that. Apple was up 1.8%, coming back up to its 50-day moving average. Amazon was down 0.25%, and we're starting to see this shorter-term moving average in danger of crossing below the longer-term moving average, but that still will take a while to develop. Microsoft was down 1%, but still above its declining 50-day moving average. Also declining with Google with the moving average, but up 0.33%, slightly above its 200-day moving average. And Meta was up 0.1%. Still, this is probably the best looking chart of the Magnificent Seven right now. NVIDIA was down 1.92%, dropping below its 50-day moving average, and also seeing that rolling over continue. Tesla was down 0.29%, pretty much on its 50-day moving average. And Netflix was down 2.33%, but still above its 50-day moving average. And we're seeing a little bit of an improvement here with the short-term correlation between U.S. stocks and world stocks. Longer term, it's still maintaining a pretty solid relationship. We're still below 70 with oil. We're watching that more for geopolitical reasons. The dollar was up, but it's still in a downtrend. And we were up with the 10-year yield. We were down with the 10-year price. And we're still uninverted here with the 10 to the 2 yield curve. And we're still inverted. Did I say uninverted here? This should be inverted here with the 10 to the 3-month, and it's got a ways to go. And we're also watching this, the decline in the 3-month yield. This is similar to what happened back in 2007. We don't know if that means what it meant then, if that means the same thing now. We're just watching this for the time being. And not really showing much of an improvement with Qs to S&P with our growth to value ratios. We're still looking better here with discretionary to the S&P, but large cap growth to large cap value, it's still on its moving average. So on the moving average with the large caps, declining, or on a declining moving average with the mid caps, and below the moving average with the small caps. We're just not getting much help here. The S&P to utilities ratio continues to decline overall, even though it was up slightly here. We want this to go up, and it's been going down. And we want this to go down, and it has been going up, even though we did see a bit of a decline when we compare staples to the S&P on a ratio basis. And then if you don't know about the Hindenburg-Ullman, this just kind of explains the three criteria that go into it. And we're still working off of that second spike. So this means it's confirmed, and we'll just have to see how things play out going forward from here. So what's our outlook for Thursday? We're still positive with our technicals, but we have this confirmed Hindenburg-Ullman, and we're already in, but we're coming into the deeper part of weak seasonality. We're going to get weekly jobless claims and continuing claims, the Philadelphia Fed index and existing home sales, and we're going to get the leading economic index. And then we want to keep an eye on all the crazy stuff going on, like PagerGate and those things happening. And then here is Thursday's list, and we're not going to have any economic reports on Friday. So the market's going to be pretty much left to its own devices as far as that's concerned. Here's another highlight of Thursday's economic reports. Seasonality, we're neutral to positive with the Dow. We're neutral to negative with the S&P and NASDAQ. We're okay. We're up 55% of the time and down 45% of the time during options expiration week. When it really turns negative is the week after. We're only up 30%. We're down 70% of the time. So we're still dealing with some potential positive seasonality for right now before things end up getting a little bit weaker here. Thursday is one of the more positive days in 2023. It's also the most positive day in 2024. So we got that going for us. But we're into this yellow area now where we typically do see weak seasonality. And we're also comparing, just because they look kind of similar, what's happening in 2024 with what happened in 2023, where we came down into that low in late October, and then we're able to bounce up out of that. So what are the warning signs? We do have a confirmed Hindenburg-Ullman, and we're dealing with weak seasonality. We're keeping an eye on the defensive sectors. Didn't really have much of a play in Wednesday's session. The staples and utilities and healthcare. We're mainly watching energy and oil more specifically to see if that's happening there, but it's really just not. We're still in the process of turning more positive with the S&P 500 oscillators. The ease of movement is still negative, but improving. It could switch over and go positive. And the copy curve is still negative, but improving. And the growth of value, discretionary to staples aren't really helping things, at least right now. So on the positive side, we have our three smart money indicators: the accumulation distribution, the Chaikin money flow, and Chaikin oscillator. They're all still positive, but they're declining, and that is a concern to us. The equity put call ratio based on 5 days, it's going down, but starting to get extreme. The 10-day chart is still just declining. The advanced decline lines are still looking good. Both the S&P and NYSE McClellan oscillators and summation indexes, even though they declined, are still positive, at least with the McClellan oscillators. The Swenlin trading oscillator declined on volume, was up based on price, but it's still positive altogether. The parabolic SAR and the bullish percent indexes for the S&P, NASDAQ 100, and NYSE are positive. The Vortex, the money flow, and the ultimate oscillator, they are all positive. The ultimate oscillator did decline. And the momentum for the NASDAQ 100 is positive, as well as the financial sector. So what's our conclusion? We're positive, but we have a confirmed Hindenburg-Ullman, and we're also dealing with weak seasonality. The smart money indicators are positive, but declining. And that's really more for the short term, because we'll have to see if things adjust in Thursday and Friday session. But we're still positive for right now in the short term. We're also positive, but more intermediate term is the weak seasonality and the Hindenburg-Ullman confirmation, where we're still just positive across the board in the long term, even though we're a little extreme with our 150 and 200-day moving averages. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.